As the European crisis drags on, some Spaniards are packing up and leaving their country behind. I'm Louise Story, reporting for Business Day Live. There are some parallels between Europe's debt problems and the municipal problem here in the United States. We'll return to that in a few minutes with the Times' Wall Street editor. And we'll take a look at Americans' level of financial literacy. But first, we welcome Tanzina Vega to talk about her article today about the lack of diversity in the advertising industry. Hi, Tanzina.
Hi, how are you?
Great. So these numbers are striking. You know, you have in here the number of Americans who are minorities. It's just over a third of the country.
That's right.
And then the number of people in the advertising industry who are minorities, and kind of a positive take on it would be that it's about 15%. So where are the minorities in the advertising industry?
Well, that's if you're being generous with the numbers. And also, that's the big question, right? Where are the minorities in the advertising industry? And what we're seeing is the whole story is basically taking a look at the fact that they've opened up the pipeline at sort of getting people involved and interested in this field, but they're having trouble with retention and at the higher executive levels in the company. There's a couple of things that we're seeing here. First is that you've got all of this interest in creating advertising campaigns to speak to the 50 million Hispanics, the nearly 50 million
Well, because you want them to buy your products.
You want them to buy your products. You want to create culturally relevant messages for them, and that's its own issue in and of itself. You know, how are we doing this? Are you doing it in Spanish? Are you doing it in English? Are you speaking, you know, to the right people? Do you have multicultural agencies that can speak to that? But internally within a lot of these companies, the hiring practices have been scrutinized pretty severely. And we're talking a couple of years ago, there were an investigation into a lot of the major advertising companies and holding companies that prompted a lot of this sort of initiative. So,
okay, so this isn't just about being nice or good business. This might also have to do with avoiding discrimination lawsuits and that sort of action.
Exactly. And some of the executives that I talked to, one of them said, you know, a lot of the numbers that they didn't want to provide a lot of numbers because one said, you know, it could be considered litigious. And so you've got a lot of concern here about where the minorities are in this industry. And there was so much so that last year at Advertising Week, there was a panel called Where Are the Black People? Right, so the industry is really making an effort to try and diversify. The question is, how are they going to do that? And that's what the story took a look at today. The Advertising Club of New York has a $700,000 initiative that it's raised money to support different programs at all levels. So at the high school level, getting people interested in advertising, at the mid-career level, training people who are sort of mid-career in advertising, and then at the executive level, you're looking at how to make decisions and programs like Hyper Island.
Well, so, you know, traditional advertising is a little bit going away anyways with the rise of the internet and digital media. And so in some sense, these old school ad agencies may be less relevant. Do we have more minorities in some of the newer online social media campaign areas?
That's actually, we don't have enough people, period, in those areas. I actually did a story about a year ago on how we had this gap. There's a talent gap in advertising, right? So you've got tons of jobs that are open for people who are very creative and very technical. That combination is really hard to come by, regardless of who you are. So advertising agencies, especially those that focus on social and digital, are really looking to increase their staffs, but they're not finding qualified people. So you have programs that are helping that to increase sort of the training in those areas as well.
And do you think the ad agencies are hearing from their clients, you know, that they want more minorities? I mean, plenty of industries out there don't have minorities, you know, finance is low and...
Right, that was a lot of the criticism initially when I interviewed folks for the story. They said, look, you know, we're doing our part. We've got these programs and we're really going to make an effort to spend this money the way that we think we should in terms of getting people in the pipeline and retaining that talent at the executive level. But all the agencies and advertisers I spoke to said we need to see that on the client side as well. So so
they're blaming their clients.
Well, they're saying, you know, it has to be a two-part effort. It can't just be the agencies. The client side also has to buy in.
Well, it's an important issue, and thanks so much for coming on to talk about it.
Thank you.
How well do you know finance? According to the Securities and Exchange Commission, most Americans have very low financial literacy. Does it matter? Reporter Peter Eves spoke to a finance professor and Wall Street veteran about the SEC's recent report.
Do you think it broke any new ground?
The report, I think, confirmed a lot of what we've known in academic circles, at least for about a decade, which is that, you know, American households have some serious issues with financial literacy.
Well, I mean, the study is one of an endless stream of studies. We don't need these autopsies anymore. How many more dead bodies does Wall Street need? We haven't learned anything from Madoff. We haven't learned anything from Stanford.
Well, I mean, I do agree with the sentiment that there was a lot of academic literature out there already. I think to the extent that this report kind of brings that evidence together, makes it more conclusive, that did find the same type of behavior, I think we are now really ready to move forward.
So what sort of disclosure rules would you have introduced by now that could have stopped something like the Madoff fraud?
The first problem is when we get monthly statements at home, they're different depending on every brokerage firm.
I think a lot of times it's in the financial sector's best interest to make products as complex and as difficult to understand as possible.
The second thing is we have a lot of bad firms and bad people on Wall Street. How about when you send out a statement, you indicate the regulatory history of the firm and you indicate the regulatory history of the broker, and you make information more available and easier to obtain from the SEC, from FINRA, and the states.
What about this whole debate over whether or not your financial advisor should have a fiduciary duty towards ensuring that he gives you the best, or he or she gives you the best advice?
Right. I mean, it's an interesting question. I think at some level, it's this thin line between overbearing regulation that makes financial advice prohibitively costly and prohibitively risky to provide from the perspective of the financial provider, and kind of maximally protecting the consumer on the other side.
It's a robust, healthy debate. It's just, again, it's stupid. I mean, of course brokers should be fiduciaries. Right. I mean, otherwise, what do you need them for? I think it's appropriate to ask a Wall Street professional not to point to 100 cars on the lot and say they all go forward and backwards, but if you're paying that individual and they're taking your money, you tell me what is the single best car on the lot.
How confident do you feel that people my age, in their 40s, are setting themselves up correctly and soundly for those retirement years as they get closer and closer?
We discussed financial literacy. There's a whole other component, which is financial planning, and that is about things like saving for retirement. And it turns out that these two things are not unrelated. People that are financially illiterate also tend to be very poor financial planners.
Most average Americans' investment for the last 20 years was wiped out. Wiped out in this last great recession. You can't afford to let your money sit in the bank earning 0.5% today. That's crazy. You won't be able to retire. So the dynamic is that the public needs a competent professional on Wall Street to help them make investments. And similarly, as a business, Wall Street needs the public to be willing to take the money out of the bank and invest it so that Wall Street also has a reason to live. We can't bridge that gap today, because the public doesn't trust the industry, and quite frankly, the industry made this bed.
Europe continues to make headlines about the deteriorating finances of Greece and Spain. But here in the United States, many communities have their own problems. We welcome Patrick Scott, the Times' Wall Street editor, to draw some parallels. Hi, Patrick.
Morning.
So we have this article in the paper today about Stockton, California, a place that declared bankruptcy just a few months ago, and a professor there has honed in on a bond deal. Tell us about the deal that caused some problems out there.
Well, this one is what's called a pension obligation bond. That's essentially when they borrow money from the markets to plug a shortfall in the pensions that they have to pay for their retirees and their workers. There's communities across the country are having this problem where they have too much obligations for their workers.
So let's just talk about how this works. This is a city says, we don't have money, but we think we'll make money in the future through our investments.
Yeah,
and so we'll borrow money and we'll hope that we make enough money to pay it back.
Essentially, it is a bet on the stock market. So yeah, the interest rate that I'll pay is going to be lower than what I'll make in the markets.
That's what you hope.
That has not turned out to be the case in a lot of these situations.
Now here is the key in the story that really got my attention. This deal for Stockton was structured by Lehman Brothers, the failed bank.
Correct.
And about a year before Lehman failed, and now people out there in Stockton are saying, hey, this wasn't such a good idea. Do you think they could have any recourse, going back to Lehman and saying, Lehman's gone, what can they do?
Well, that has been the question for municipalities across the country, whether or not they have enough ammunition to go after the bankers who had convinced them that these were good deals in the first place. So There's a lot of issues with that. Sometimes the communities they're reluctant to do that because they're worried that in the future they won't be able to have relationships with banks when they need financing for their other sort of obligations.
The banks would just turn them away.
Well, there's that one concern, but there's also that these banks are obligated to deal fairly with municipalities whenever they're issuing debt.
But you
and
know
they can
that
point to that they had warned, on one point that this is not a guaranteed deal whenever you issue a bond, so you'll have to wait. Actually, if it's a 30-year bond, you won't know until the end of the 30 years whether the markets actually, on average, were able to give you enough of a return on that where you're not going to be in the hole.
That's right. It's hard to tell the future. And one of the reforms with Dodd-Frank that has been held up is this idea of putting a fiduciary duty for banks where they're obligated to give good financial advice to cities. That's been held up. What's the status on that?
Well, that is an unusual one where usually you're supposed to now deal fairly and you're not supposed to deceive or mislead your counterparties when you're dealing with these. If you had a fiduciary duty, your interest would have to be serving the client first and foremost. That's still held up in the rulemaking process. They haven't agreed on what the definition of what a fiduciary is, and there's a lot of muddledness in the rulemaking process, which has happened through Dodd-Frank.
Now we have a parallel with this, with what's going on over in Europe. You remember a few years ago when Europe first got into trouble, all this news came out about different bond deals that the bankers set up for Greece and Spain and Italy that helped mask their desk.
Made good fees off of all those.
Right.
Yes.
So have any of the Italian or Spanish debt issues, have any of those countries been able to recover damages from the banks?
Well, it seems like right now they're more preoccupied with getting their fiscal house in order. And actually this week there's all this shuttle diplomacy going on where the leaders in Europe are coming together trying to figure out the big question of whether they can really institute this economic and fiscal union and get it tighter and more controlled on the bond markets. And then later this week, the big issue is going to be with Draghi, the ECB president, and whether or not he is going to intervene in the bond markets and actually give some room to Italy and Spain in particular to give them a little bit of space so they can get their budgets in order and then not be, having the bond markets throw tantrums every time that they're not doing what the investors would like them to do.
It often comes back to the investors for cities and for the European countries, which is what makes this all so tricky.
Yes.
Well, thanks so much for joining us.
Good.
That's all for today. Please stay with us online at nytimes.com for our continuing coverage. I'm Louise Story reporting for Business Day Live. Thanks for watching.